There is an event that is about to happen that is going to affect every investor, but unfortunately, most investors have no idea what is coming. Hello, I'm Martin Straith, founder of Trend News, publisher of the Trend Letter and Trend Technical Trader. And I have a question for you. Are you prepared for the coming bond market crash? For over a year, we have been warning that we're going to see a bond bubble crash, likely starting in the last quarter of 2015. A bond bubble, or sovereign debt default, occurs when a country or countries suspends payments on their debt. We have seen this throughout history, with the most recent examples being Greece in 2012 and Argentina in 2001. Today, Greece is on the verge of another sovereign debt default. There may be a short-term, last-minute face-saving announcement where the ECB and the IMF ride to the rescue, but understand, the reality is Greece will never be able to pay off its debt. Here's a chart of the yield on the Greek 10-year bond. As bond prices decline, the yields rise. And as we can see here, yields have been rising. Now, let's look back to 2012 when Greece was in a similar default situation. Back then, the bonds crashed, sending yields from less than 9% here up to a whopping 37% in a little over a year. That is a 311% increase. Like every other sector, the bond market moves in cycles. These cycles have happened throughout history and they continually repeat. The good news is that our models can accurately predict the turns in these cycles. Since we first started publishing the Trend Letter in March 2002, our models have accurately predicted the following. The bottom in gold in 2002, the bottom in uranium in 2003, the US real estate bubble in 2005, 6 months before it happened, the global stock market bubble in 2007 before that happened, and more recently the top in gold in 2011. Understand that the bond bubble crash that we have been warning about for over a year is not just related to Greece. Greece is a tiny economy. The real problem is much bigger than Greece. Virtually every Western nation is in serious financial trouble. It doesn't matter whether the government is left-wing or right-wing, they all spend more than they have. This has resulted in all of these countries accumulating unsustainable debts. We are talking about Italy, Spain, France, Germany, and on and on. And yes, we are also talking about the US. Here's a chart of the US Federal Reserve fund rates. As we can see, these cycles last about 30 years. Many of you will, if you had a mortgage in the early 80s, will remember how mortgage rates got up to around 20%. For younger people who have trouble believing that, but it was true. But since then, all these rates have dropped down to near 0%. But that cycle is now ending. Here is a chart of the US 10-year bond. And as we can see, since mid-January of this year, rates have started to rise. And that trend is going to continue. Most of us were not around during the Great Depression in 1929. And none of the mainstream media, being newsletters or media, seemed to understand what happened back then. After the 1929 stock market crash, capital flowed into the European bond market. But what you never hear or read in the mainstream media is that 3 years after that stock market crash, all 17 of the major European countries defaulted on their debt. That's correct. All of them defaulted. Investors then realized how unsafe those government bonds were. So they moved what capital they had left and invested it in the US equity markets. Most remember how the market crashed, but no one else seems to remember how the US markets rallied for 5 years. So we had the stock market crash in 1929 here down to 1932, but then there was a strong rally for 5 years. Why did investors pour into the US equities at a time when the global economy was sinking into a black hole? They did it because they no longer trusted government bonds. That loss of confidence in government sent the capital into big, sound, blue-chip US companies. This is the lesson that no one else seems to have learned. Savvy investors understand that the reason that the S&P 500 has been rising steadily is not because of the Fed. it is because Russian, European, and Asian smart money has been getting out of the riskier investments and into the perceived safety of the US stocks. And our models have been telling us that history is again going to repeat. So what will happen next? First, we will see a peripheral country, likely Greece, default on its debt. That doesn't have to be a complete default. It could be a major haircut, say 40%. When that happens, we will see contagion as bondholders of other government bonds will look around and they're going to ask, who's next? This loss of confidence in government will cause investors to move their capital out of public investments, that being bonds, and into private investments, equities, collectibles, precious metals, etc. We are already starting to see investors dump the longer term bonds such as the 10 and the 20 year. And what they're doing is they are moving into short term bonds and they're buying equities. As the bond bubble crash spreads, then we will see retail investors follow that smart money and move into US equities. By the time the herd joins that party, we will be looking to sell to those late to the party investors. The timing of these moves is critical. The problems will start in Europe, spread to Japan, and then North America. Once it hits the US, we are going to see a massive deflationary force hit globally. There will be huge gains to be made for those who understand this global flow of capital. But unfortunately, there will also be massive losses for those who do not understand this. In summary, once the bond bubble bursts, we will see capital leave public investment, bonds, and move into private investments, equity, gold, commodities, etc. We have warned for months that if you own long-term euro bonds and really any other longer-term bond, look to unload them on any rally. And if you haven't acted yet, you're running out of time. We will be issuing new recommendations soon via the trend letter to position our subscribers to profit from these huge moves that are coming. To survive the next 4 to 5 years, you must understand how this global flow of capital influences all markets. Stay tuned. Now, if you're not a subscriber to the trend letter, we are offering a very special $200 discount or 40% off our regular price of $499.95. So that very short term, you can get the trend letter for $299.95. To take advantage of the special offer, simply go to thetrendletter.com/node/2792. If you have any questions, just drop us an email at info@thetrendletter.com. Have a great day.